The infamous 3 to 6 month emergency fund. Run a simple Google search and you'll see this one-size-fits-all advice peddled by the vast majority of financial folks out there. In my opinion, the traditional emergency fund does not make sense for a lot of people. In fact, my wife and I have an emergency fund of precisely $0. If you came here just for the investment topics, please stick around. I promise this has large implications on your investments. By the end of this video, you'll know why holding a traditional emergency fund may be costing you tens of thousands of dollars. Real quick, before we jump into the video, I want to be clear, I am not telling you what to do. My surface level goal today is to challenge you regarding your beliefs on the emergency fund, but my larger goal is to get you to think critically about advice put out by the mainstream. Here at Phil Thompson Investing, we are all about nuanced investing made simple. Today, I'm going to break down this topic into 4 easy steps. So, before you grab your pitchforks, please be sure to wait to the end of the video to form your opinion. Let's begin. The reason one would not want to have an emergency fund of cash sitting around is simple: opportunity cost. A person misses out on compounding investment returns when they have cash sitting on the sidelines. Let's say a person spends $3,000 per month. So, a 6-month emergency fund is $18,000. This $18,000 loses value to inflation since inflation is higher than the interest paid by savings accounts. On the flip side, if someone earns 7% a year adjusted for inflation by investing in an S&P 500 index fund or ETF from age 30 to age 65, this becomes over $205,000. Not enough to retire, but certainly enough money to make a difference. Even if the emergency fund is half the size, only 3 months worth, $9,000 grows to over $102,000. In the first example, the emergency fund perpetually loses value when it sits as cash in a savings account, whereas it multiplies by 11 in inflation-adjusted dollars when it is invested over this same time period. To set us up for success, we need to have good defense. Catastrophic emergency expenses usually come in 3 flavors: home, auto, and medical. We must have adequate liability coverage for both our home and our auto policies. In addition, we should have adequate medical coverage. By doing these 3 things, we're able to limit our maximum out-of-pocket cost per year or per event. Without doing this, we essentially have a chink in our armor that leaves us vulnerable. A lot of insurance products out there are a waste of money, but having good insurance with these 3 areas is usually a great idea. Step 1, checking account buffer. In the event that a surprise expense does occur, the first line of defense is extra cash in the checking account. My wife and I like to leave an extra cash buffer in our checking account so that we don't have to worry about cash flow during the month. That way, if there's a $1,000 or even $1,500 expense that happens, we don't really need to change anything that we're doing to cover this expense. The vast majority of emergency expenses are going to fit into this category, but if it's something larger, we're going to have to move on to the next step. Step 2, credit card float. A lot of people talk trash about credit card companies because of how much interest they charge. But for people who use credit cards strategically, they know how much benefit credit cards provide. Cash back and points are one thing, but as far as this conversation goes, I'm talking about credit card float. A lot of people don't realize this, but credit cards offer you the ability to have a 1 to 2 month interest-free loan. Depending on where in the statement cycle you charge something, you get up to 2 months interest-free. My wife and I have several credit cards, so if we had a larger expense, we would simply choose the card that most recently posted a statement and therefore has the longest float. Then, my wife and I would receive between 6 and 8 paychecks before needing to have the cash to pay that credit card bill. Even if you only have 1 credit card, you'll still get a minimum of 1 month interest-free. For us, this strategy, along with our checking account cash buffer, would cover any expense that is a few $1,000s or less. The size of the gap between your monthly income and expenses will dictate how big of an expense you can cover using steps 1 and 2. The greater the difference between your income and expenses, the better. Realistically, most emergencies that we encounter can be covered by steps 1 and 2. However, life happens, and sooner or later we may run into a situation that requires more aggressive measures. In step 3, we've got a few options. First, we can sign up for a new credit card that offers 12 months interest-free. If we can't get this credit card in time to pay the expense directly, we could spend on an existing credit card and do a balance transfer to an interest-free card for about a 3% fee. The interest-free period will provide us the time to pay it off with our normal income. Certain companies are known for offering large credit limits. Chase Bank, for example, will likely provide more than enough credit for most emergencies. Before we move on, I want to quickly mention that I am not an advocate of using credit cards to buy something that you would not otherwise buy with cash, nor am I recommending that you ever pay any credit card interest. I personally have never paid a single dime in credit card interest, nor will I ever do it. Please be smart with your credit cards and use them strategically. A few other options that you may want to consider would be a personal line of credit. Some banks still do offer these, and if you can get one with a decent interest rate, it may be a good option. Next, you could look into getting a home equity line of credit. If you've got significant equity built up in your home, this may be another great option for you. Fourth, if you've got a decently sized brokerage account, you might want to look into getting a margin loan. Some brokerages already offer very good interest rates, but even if your broker doesn't offer favorable interest rates, if you call the customer service line, sometimes you can get them to decrease that rate for you. No matter if you use any one of the ones that I've mentioned or if you use an option that I didn't mention, step 3 is all about just finding access to capital or cheap debt in order to get us through the emergency. Critics will say that these methods are all high risk and they'll reject any and all options that involve using debt. Now, they're right, nothing is risk-free, and I'm not suggesting that there's no risk at all here. But the risk that does exist is very small in my opinion. Besides, while I'm paying off my interest-free credit card, the person with the traditional emergency fund will be replenishing their cash cushion. Only my money works 99% of the time in the market, whereas theirs collects dust in a savings account. All right, we've made it through steps 1, 2, and 3, and it's still not enough money to cover the emergency. So now what? Well, in step 4, it's very simple. All we do is we take some stock in our portfolio, sell it, and then move that money over to our checking account and pay for the emergency. It's really that simple. Our entire portfolio is one giant emergency fund. We don't need to set aside money, bubble wrap it, and keep it in a savings account for it to be considered an emergency fund. Everything is fair game in step 4. Haters will say that if you use this method, you may end up having to sell stock at a loss. And, well, they're right. That could happen. But over the course of an investing lifetime, it's better to stay fully invested. Now for a few exceptions and considerations. If you're a person who has lots of credit card debt, none of this information applies to you. You should be taking every single penny you have and paying it towards that credit card debt. There's no reason to have it, and because the interest rate is so high, you shouldn't have any emergency fund whatsoever. Perhaps the best reason that I've heard in favor of keeping an emergency fund is the sleep at night factor. In other words, a person feels that they'd have too high a stress level if they didn't have any cash on hand. But what I'd ask this person is, what is it about my strategy that is any less safe or secure? Besides, we're all about changing our psychology to fit the math, not the other way around. There are some people who should have an emergency fund. If your net worth is low or even negative, if you've got income that is irregular or clumpy, or perhaps the assets that you do own are hard to convert to cash, it may make sense for you to have an emergency fund. To summarize, in the event that I encounter an emergency expense, the 4 steps that I follow are this. Number 1, checking account buffer. Number 2, credit card float. Number 3, low or no interest debt. And number 4, my brokerage account. The bottom line is that for most people, the traditional 3 to 6 month emergency fund just doesn't make sense. The person who chooses to invest what would otherwise go into their cash emergency fund will finish their investing lifetime ahead. Even if you haven't been completely convinced, you may want to consider moving to a 1 to 2 month emergency fund. Even doing this will dramatically improve your investing returns. We will wrap up today's video as usual with a portfolio review. Only made one move so far this week. I sold a few additional Tattooed Chef 1750 strike put options expiring July 16th. So I have 4 contracts there. The other thing that I've been watching is Micron Technology and their stock price. I purchased them a little bit below $80 and was hoping their price would stay down a bit. They've since gone above $80. Today they're down, but they're up overall for my cost basis. So I'd like them to go back down below 80 before I add a few more shares in the coming weeks. So this is it. This is the portfolio. This is the place that I'd be accessing capital should I reach step 4 of the emergency fund plan that I laid out in this video. Right now we're sitting just below $70,000 worth of total equity here. So this is what I'd be using in the event that I made it to that point in that plan. Next, I'd like to direct your attention to a comment that I received from someone in a previous video. They were wanting my thoughts on a segment from John Oliver where he talked about index funds and why they're a good choice for many investors. This is just one article that I found on the topic. I agree with most of what is said here. John said, and this article highlights how index funds have lower fees than actively managed funds. It's a very passive approach to investing whereby an investor just needs to continue purchasing more and more of the exact same fund, index fund, or ETF version of that fund. And it's a great way to keep up with the investing returns of the overall market. And John mentioned that most professional investors can't even beat the stock market index, whether it's the Dow Jones or the S&P 500 that we're referencing. If they can't beat it, then why not just join it? And it's a very hassle-free, easy way to do so in buying index funds. So to answer your question, yes, I agree with John, and I am also a big proponent of index funds for many investors, particularly those who don't want to be as active with their investments or just want to have an easy way to go about investing. So it's really that simple. If someone's not wanting to purchase individual stocks or take the time to research and look into companies on their own, index fund investing is a fantastic way, and it's a way that I would potentially recommend to people that they look into. So that'll conclude today's video and today's portfolio review. Thank you so much for watching. If you made it this far in the video, please give me a like. And until that next one, peace.